Good morning. Welcome to Trading Hour. I am Reema Tendulkar with Mia Soneshinoy and Pavitra Parekh. And as the trading day progresses, it's getting worse for our markets. The sell-off, Currently down 130 points on the Nifty, 17,970. A level to track will be the 100-day moving average, which is 17,900. The banks are under pressure. The Nifty bank has slipped close to about 1%. The PSU banking index is down 2%. IT heavyweights are taking a knock. Nifty IT index is down nearly 1%, with names like TCS down close to about 2%, Infosys losing 1.5%. But it's not all lost, right? It's not a broad-based sell-off today, because today you've got the Nifty Auto Index holding up in the green with a gain of about 0.7%, led by Tata Motors. The Healthcare Index as well is showing you some green to kickstart trade with names like Apollo Hospitals, Divi's Laboratory currently up nearly about 3/4 of a percentage point. So it's a weak day. The morning has been definitely weak, 500 points lower on the Sensex, but it's not a broad-based sell-off. The advanced decline ratio, though, isn't firmly in favor of the losing side. 2 stocks in the green for 3 in the red.
Hi, morning Reema, morning Pavitra. I think the IT index, the TCS itself is dragging the Nifty lower by about 20 odd points. So it's largely skewed against the IT stocks. The good part is that the Nifty is holding on to that 100-day moving average of 17,906. That seems to be the line in the sand on the downside, at least as far as technical experts are indicating. And a lot of the stocks are seeing profit taking. So Bharti, Airtel had a very good day. Some money being taken off over there. There is risk aversion for sure. But for now, some levels are holding. Let's see whether it escalates through the course of the day. It's also a lot of banks that are exerting pressure today. So the bank Nifty is down 450 points. Let's see how it goes. But lots of stock-specific action today.
Oh, absolutely. And we'll talk more about that because, like you said, a lot of news from the auto space as well. So that entire pack doing well. In fact, some of the auto ancillary companies also doing well, right? Sona, BLW, of course, are news. But there's something like an SML, Isuzu, Atul Auto, all of these stocks doing very well from the smaller companies. In addition to autos, there is some of the metal names that are holding up really well. So a few of those will be up for you, and some of the PSUs. So some of the, the likes of ONGC, Power Grid, these ones are holding up as well. Of course, it is the banks and tech which is under pressure, and that is exerting a lot of pressure. But remember, we have a lot of cues to track. Fed Chair Powell will speak later today, so that is going to be extremely important from a market standpoint. You have a lot of macro data ahead in this week. India CPI and IFP data will come out. It will come out from the US, Japan, China, UK. So we're waiting for a bunch of that data. And of course, you do have Brent prices to track. That will be all important. And then the tech earnings. This is a big week for tech earnings. So once TCS is done, so now we have the rest of the pack, which will also post their earnings later in the week. So that is what we're tracking in terms of cues. But let's start with TCS then. IT Bellwether kicked off the third quarter earnings season with a revenue beat. There was a mild miss on the margin front, but the stock has slipped after opening in the green. It is also off the opening, the lows that we saw today. But Reema, what really has the stock under pressure?
Well, 1, there is still no clarity on future demand, FY24, FY25. 2, the deal wins have moderated on a sequential basis. $7.8 billion of new deal wins in Q3, which compares with $8.1 billion in the prior quarter. The headcount has come down. One of the reasons for the headcount to come down is because attrition is coming down. The company is already hired aggressively in the first 9 months of the year. But the other reason could be, and that's what the street is reading, is that the company is preparing for some sort of a slowdown. And remember, TCS's headcount has declined only thrice in the last 1 decade. So this is a fairly telling point. Apart from that, the management commentary is also indicating to rising caution in the European region, which contributes about 15% to their revenue. And just take a look at what the deal wins are, right? One would assume that deal wins today would translate into revenues tomorrow. Now, in FY22, the company had deal wins which went up by 10%. There was an increase in their deal wins by 10%. And this is translating into a double-digit growth this year. But in the first 9 months of FY23, the deal wins have gone up by only 3.5% on an aggregate basis, which perhaps gives you an indication that in the coming years, not necessarily FY24, but in the coming years, the revenue growth will be slower. Also, look at the street expectations. The street is penciling in that growth is going to slow down significantly. In FY23, Morgan, Kotak, they're all anticipating TCS's constant currency revenue growth to be about 13-14%. But next year, they expect that growth to come down to 7.7, 7.9% respectively. So the street is penciling in a significant slowdown. The stock is also currently trading at 25.5 times forward multiple, which is higher than the historical average multiples that the stock used to enjoy pre-COVID, which was close to 21, 22 times. So these are a couple of reasons which could be weighing on the stock. Earlier today, we caught up with the management of TCS. Listen in to an excerpt from that conversation.
Our business is on a very focused customer set, both from a market perspective as well as from a client universe perspective. So the way I would look at it is, rather than try to parse the overall big global economy picture, if you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today compared to 5 years ago or 10 years ago. So balance sheet repair has happened. The easy money actually resulted in a fairly good disciplined execution on that side. The financial markets, of course, react to the repricing of the asset on terms of where the interest rate is. But when we are looking at actual individual companies, they are more impacted by the supply chain issues, which have kind of played out through the year. They are in fact on the absolutely on the getting mended. Geopolitical issues in Europe will continue to have an impact, especially for that market and for some of the long supply chain kind of industries. But others in UK, in US, they are in a much more stable situation. So our own view is that there will be some impact of the overall negative commentary that is there in decision making. But when we take let's say a 6-month view or a 12-month view, we are much more positive, because we believe that our client universe, their underlying business is in good shape, and that is what is driving our positive outlook on our business compared to where the overall economic commentary is.
2.2% growth and an improvement in margins is not a small achievement given the circumstances. So what led to that, both these positives?
I think it's a very, very satisfying quarter, 13.6% year-on-year growth. I think we stayed very focused with customers, being part of them, working with them, put feet on the ground to see what matters to them in these tough times, right? Especially as they grapple with uncertainties in the macro side. What does it mean for them to stay ahead of the curve? Where is it that new technologies can help them bring efficiency, help them bring automation, and then at the same time work with them to define the future now, right? And I think that's what really is. In a nutshell, I think it's about cloud, right? Everybody moves everything to cloud, and
as you call the race to cloud.
Yeah, race to cloud, and then it's about you don't stop by moving to the cloud. You keep improving it, you keep bringing in automation. The beauty of these digital technologies is that a new technology comes in, a new way of working comes in every month, right? So short is the improvement possibilities, with the result that customers are always willing to adopt something new for bettering the growth, bettering the efficiency, and bring in innovation to differentiate themselves in the marketplace.
Okay, well, I have more on that, but before that, Milind, while it is a large number you hired in terms of freshers, the street is a little worried that your total headcount is actually a few thousands less. Okay. Is that preparing for likely fewer orders in this year?
So a couple of points I would make. One is basically if you look at year on year, we have grown by 57,000 people.
Yes.
So that's almost 10% growth on the number which we had last year. And we also hired a lot of people last year, and basically close to 200,000. And then a lot of talent development over the last 3 quarters, and eventually they are getting deployed now, in this quarter, and thereby increasing the utilization a bit, and also efficiency in the organization is basically causing this headcount to come down. But actually, if you look at it, look at 2 years together, I think we'll be even.
Samir, I wanted to ask you about the margins. It's impressive that at a time like this, You are, not only delivered better margins than quarter ago, you're promising to exit at 25%. How are you so sure, and what led to that improvement?
Okay, fair. So I think this is still an aspiration, but we have put it out at the beginning of the year when we gave our full quarter increments, and we came in at 23.4. We said we want to exit this year at 25, and structurally we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. Two specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year, and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
And there is still space over there?
There will be operational levers from an execution rigor perspective, which always will be there. Fees to external consultants still provides us an opportunity. There will always be puts and takes in terms of how it would set up. Second factor is currency has been beneficial to us, and that also we have been calling it out.
Okay, well, the market is still under quite a bit of pressure. So the Nifty is now down 135 points, and there is no sign of respite in the market, on the equity markets, that is. So let's do one thing. Let's take a quick break. When we come back, we will track the commodity space with Manisha Gupta. So to come back to Trading Hour, as promised, let's shift focus now to the commodity space. Manisha Gupta joins in. And today we're focusing on our favorite topic here in the studio, coffee. Manisha, what's the latest there?
Well, a rebound really, because we started this year with nearly 16-month lows, and last year we saw the coffee prices decline by 26%. But currently, in the last couple of sessions, there has been some strong rebound that we've seen come in for the coffee prices. The inventories rising will continue to perhaps weigh onto the prices, because in December we have seen inventories gain up on ICE futures at around 814,000. In the month of November, that was at 380,000. So a sharp jump up when you look at inventories there. But all the other numbers clearly seem to be turning in the positive side. When you look at the global production numbers for coffee, in 2020 and 21, it was at 170 million bags. In 2021 and 22, that figure has come down to 167 million bags. Also, when you look at the global coffee consumption in the current season is expected to gain up by 3.3% and more than what we are looking at in sense of production. So that clearly is supporting the prices. Also, when you look at the November numbers which have come last evening, also show that the coffee export numbers also seem to be on the positive side. The total coffee global export has gained up by 9.2%, and within that Arabica is 8% and Robusta at 11%. So clearly coffee as a commodity seems to be picking up as when it goes to demand.
All right, Manisha, thanks a lot for getting us all of those details on coffee prices and the move there. But let's also bring you some important opinion now. This comes in from Liz Young, Head of Investment Strategy at Sophie, on the inflation outlook as well as, how the markets could move in the coming year. Listen in.
It's possible and probable that inflation comes down pretty well in the first half. It might come down very, very quickly, and the market is going to cheer that. The move on Friday was really predicated almost solely on the fact that wage growth relaxed. And we got this jobs data on Friday that kept the hope for a soft landing alive. The only thing I would caution people on is that the stock market and wage growth alone does not reset the economic cycle, does not solve all of the problems that we have. The risk of a wage price spiral maybe got reduced for a little while, but that doesn't mean that the risk is gone. And what we're seeing right now, especially in some parts of the labor market, definitely parts of the consumer data, is that economic data is weakening. If you want inflation to come down, you have to bring demand down. That affects consumer spending, that affects corporate profits. I don't think we've seen the end of the bad news. I'm not a short-term trader, so if you look at just where would the growth be, where would I bite if we're trying to find growth, it's probably not in tech, it's probably not even really in large cap at all.
Okay, that is some important opinion. The market, by the way, has slipped even further. So it's now a 145-point cut that we are seeing on the Nifty, largely led by the IT index, as well as what's going on with the Nifty Bank, which has also slipped further. It's almost 480 points lower on the Nifty Bank. So let's take a quick break. But when we come back, we'll discuss the market technicals. Mitesh Thakkar will be with us. Hey guys, welcome back. You're still tuned into Trading Hour. Mitesh Thakkar is with us for a quick technical check on the market. Mitesh, good morning. We've seen quite a slip, right, from the opening levels. We're currently around 140 points in the red. But this isn't really such a broad-based sell-off. We do have some pockets of strength still, such as the auto pack, a few of the metal names. How would you look at it right now, and what is your call on the index?
Yeah. So I think breaking below 18,000 was slight negative. The only good thing is that yesterday we had a gap out, which is around 17,900, 17,880 zone. So I'm hoping that level will hold. But otherwise, it's a market, if it fills that, then I think we are looking at definitely a break of 17,800 and then a test of 17,720, 700 to begin with, and then maybe even lower. So the texture today has slightly turned on the negative side, despite the fact that we had taken a long early in the day, which got stopped out. On the stock side, I have one buy and one sell. Eicher Motors is breaking down. So it's a sell with a stop at 32.40 for targets of 3,100. And a buy on, a buy on GSPL, that's making a fresh highs. That's a buy with a stop below 278 for targets of 310.
Okay, those were two trading ideas. Mitesh, thank you very much for joining in. Another stock that we're tracking today is Cyient. The company has announced to its exchanges that one of its arms, the design-led manufacturing business, has filed for its IPO. It's filed the DRHP with the SEBI and it's looking to do an IPO. This, remember, is in line with the company's intent to unlock value in the DLM business or design-led manufacturing. Remember, just 2 quarters back, the company had even formed a committee to find out different ways and methods by which they could unlock value in DLM, whether it was by partnership, some strategic infusion, or even listing plans. Now, what exactly is the design-led manufacturing business for Cyient? Now, Cyient is an engineering R&D kind of service. Now, for instance, if a airline company goes to Cyient and says that we want to design the nose of an aircraft, right? Now, Cyient, the services part of it, would just design how it's supposed to look. But DLM would even manufacture it. So they would manufacture a prototype of it. So which is why it's called design-led manufacturing. Cyient would only, or any IT services company will only design it for you, right? How the engineering part should look like. But DLM will help you manufacture a prototype. But typically, this business has lower margins because ultimately it's in manufacturing. And secondly, you're not manufacturing at scale. You're only manufacturing a prototype for its clients. But this is a business which is a part of Cyient. Cyient had acquired a company called Rangsons Electronic in 2015. So it's been with the company for the last 7 years. It's into design-led manufacturing, and now Cyient wants to list it separately. According to the details shared by the company, it's going to have a fresh issue of 740 crores, and they may consider a further issue of equity shares up to 148 crores. So totally, we're looking at about 880 crore. The financials of this DLM business, well, this year, the company has said the DLM business will have high single-digit kind of revenue growth. In FY22, its revenues were about $105 million. So not very large, but margins were at 7.2%, and DLM is about 15% of Cyient's revenues. Now, this is incrementally positive for Cyient because, one, it will, once it's a separately listed entity, it will give them greater flexibility to scale up. My sense is perhaps there wasn't that much of overlap between Cyient and, DLM's clients. Maybe Cyient thought that, once we get the client on board for designing it, we will be able to give it to our DLM business and help them manufacture. But perhaps that didn't take place to that extent. And now by making the two entities separate, they will be able to scale it up, and plus it unlocks shareholder value. So this is the fresh move, the update that's come through on Cyient, where a business of theirs, DLM, is now looking to list separately in the exchanges. The DRHP has been filed with the SEBI. Data coming out.
Yes, there's the mutual fund data that has come out for the month of December. The equity inflows look pretty good at the moment.
Yeah.
So, Pavitra, did you take a look at them?
Yeah, it looks a lot better. I mean, remember last month we did see quite a contraction, but this month is coming at around 7,200 crores. This is versus the 2,200 crores that we had last month. That is for the month of November. I was actually looking at the large cap funds because, last month there was quite a contraction there. We saw a near 1,100 crore outflow in the large cap funds for first time in a while, right? So there is a contraction once again, not as large at all, but around 26 crores of an outflow. So it is still a negative figure. That is what has come in on the equity funds. I'm waiting for more details, and let's see if I can get a few more. Yeah, okay. So the net equity inflow is at 70-80 crores. This is versus the 2,200 crores that we had. The debt scheme outflow is at almost 22,000 crores. This is versus the 3668 crore inflow that we saw. So do keep that on your radar as well. those are the figures we have for now. I'm also waiting by to see what the balanced advantage fund outflow looks like. I mean, there has been an outflow for the past 2 months. It'll be interesting to see if that is, a theme which is continuing as well. We're going to try and get you some reactions. In fact, Sunil Subramaniam is also joining us now. He's MD and CEO of Sundaram Mutual Fund. Sunil, good morning. Thanks a lot for joining us. So it looks like, we do have once again quite a positive net equity inflow number. It's coming at around 7,200 crores. There was a contraction last time, but how are you looking at this? Because, while this number looks positive, there is once again an outflow in the large cap scheme. So how are you reading this?
No, I think that basically the December month was where there was a little bit of profit booking, and naturally that's more on the large cap because valuations had run up. Because if you saw July to November, FII flows had returned very strongly to Indian market, and valuations had risen up, and that was more oriented towards the large caps because FIIs naturally focused there. So the sharp rise in those valuations meant that people who had invested in large caps a few years ago saw that it's a good time to book profits, and some of that is spilled over into January too. So I would say this is just more profit booking at this point in time, but otherwise flows across schemes I think are quite healthy, fresh inflows.
Okay, flows across schemes are quite healthy. In fact, we have been talking to a whole host of experts on the large cap picture, because that has been sort of that's also where we've seen sort of, the outperformance has not really come in, right? So, Sunil, just a question on the large cap schemes, since we're talking about this, there's been this huge debate about the passive versus active investing in large caps. Are you also part of the group that believes that large cap investing is better done with the passive schemes?
No, not really. See, I would say that it depends on if you're an institutional player where even small amount of cost differential makes a difference and you're going to be churning your portfolio in and out, then passive makes sense. But if you're a HNI or a retail investor with a longer term outlook, you see the reason that in the last few years there has been this passives doing much better than actives in the large cap space is partly driven by the fact that a few stocks in the index have rallied a lot, and those are either not held by fund managers or not held to that extent because of regulations. So there has been a bit of a challenge for active fund managers in the past, but I don't think the next few years are going to replicate that entirely, because I see that as action shifts to domestic economy, you will find that there's far more value to research of fund management and delivering that value as opposed to do purely a liquidity from overseas driven rally. So I think I will say that yes, large caps will be the ones which are most under pressure to beat the benchmark because of ETF flows, but that doesn't mean that there can be no alpha. I do believe that over the next few years, we will see alpha returning. So I'm not fully in the camp of saying, didn't large caps do only passives? No. I think a blend of the two is what I would recommend.
We're talking about, some of the Adani Group stocks, right, that led to a big outperformance in the passive funds versus active. I mean, I take your point entirely. I wanted, and I mean, for the sake of fund managers, I'm hoping that they can generate alpha in the year to come. I wanted your thoughts on hybrid funds. After many months of an outflow, there's an inflow this time, I think 2,255 crores. Your thoughts here, and what is the, prognosis now?
So I think that hybrids tend to get more money when the volatility increases and there is this doubt about equity debt asset allocation. So some people who get doubts in the head then tend to go into a hybrid where the fund manager takes that call. So over the last few months, right before this month, you saw that equities were rallying very strongly. So lots of people felt that it's better I'm putting in a pure equity fund and taking that, and why take any debt exposure even in an hybrid. But given the valuations that rose over the last till November, right? Now this month you're seeing again that those valuations becoming something that an investor starts thinking about, and he says, should I put more in debt? Then one of the options is that to do it through the hybrid, where the fund manager chooses the right amount of debt, the right maturity duration of that debt, and the lot. So I think that as debt becoming more attractive with better long-term yields, right, some of the investors feel that playing that through hybrid is better, because then tomorrow a situation comes where equity valuations look comfortable and you want to increase it, you're not left with that decision at your end, but the fund manager can take that easily with no taxation impact at your end. Remember, an investor making an equity allocation and debt allocation has to constantly keep the 3-year taxation for debt and the 1-year taxation of equity in his mind when making these decisions. So hybrids as a category, until valuations come back to a reasonable level, will, I think, from this month start getting increasing allocation.
But then, Sunil, how would you explain what's going on with the balanced advantage funds? This is the third straight month of an outflow that we're seeing there. Initially, when we started seeing an outflow, the sort of reason that I got from the entire industry was that, equities are looking so attractive, so maybe people are going for pure equity funds, and that might be a more attractive. But, I mean, clearly you're saying debt is attractive, so why is that not showing through in the balanced advantage funds? And is this a trend that you expect will continue? I mean, the outflow from this category.
Yeah, but isn't that logically following? Because what's happened is in balanced advantage funds, the balanced advantage managers have been increasing the equity allocation and reducing the debt. So clearly, when an investor feels he wants more debt in his portfolio, he feels that I'll pull that out from balanced advantage and take 40% debt if I need to, because balanced advantage running at 60% of equity, 50 to 60% equity, another 10 to 15% in arbitrage, and only the balance is going to debt. So the debt component of balanced advantage is very low, and ideally, if an investor feels he should have more debt today, then it's better that he does it on his own, right? And that's why he pulls out from a BAF and tends to put debt allocation on his own and equity on his own. Right? And second aspect is in the BAF is that the fund managers tend to keep the debt short because they want the flexibility to keep switching from debt to equity.
Right.
So if they take long-term calls, there's a mark-to-market loss risk. So they keep a short-end debt. Whereas if an investor, you want to lock into a long-term yield, you're better off pulling out from the BAF and putting it into a medium-term duration debt fund or a target maturity fund.
Okay.
Okay. We have Anthony Heredia as well, who's the MD and CEO of Mahindra Manulife Mutual Fund, who joins into the discussion. Anthony, what are your thoughts? There's a net equity inflow this time of over 7,280 crores. What is your takeaway from this? And given that we have such a volatile market environment upon us, what is the best way to approach it now?
Surya, I think, the flows continue to be robust. I think investors continue to invest. I think what you're also seeing, and this is a trend for the last few months, is the number of people wanting to take some money off the table is increasing month over month, right? Which is why the net flow numbers look what they are. I think volatility from our perspective is here to stay through 23. And so I would expect net flow numbers to remain at this range, at least for the next couple of quarters. The only silver lining I can see is, after a couple of months of small and mid-cap funds not seeing too much of flows, I'm seeing some very interesting, strong numbers in that segment. So that's a positive. I would expect the trend on fixed income to start to turn. I can see a lot of commentary from us and a lot of our peers talking about investors needing to allocate towards fixed income. I think one of the realities is that fixed deposit rates are obviously at their highest at this point. So that's a challenge. But I think you will find that over the next few months, we will see flows remain in this kind of range. And I would believe that balanced funds and fixed income funds will start to see some flows. And that will be a consequence of volatility. And I think it's a consequence of the investors' view on valuations in the market.
Okay, got that. Anthony, good morning and thanks for joining us. This is Pavitra. So you were saying that, you could see the fixed income space gets more inflows. Can you tell us what it is you expect? I mean, we've seen around 22,000 crores this time around. How much of more inflows do you expect in this space going forward? Because this has been picking up anyway slowly, right? I don't know if you heard us talking to Sunil earlier. He is saying that people seem to be pulling money out of the balanced advantage funds and going for a more like pure debt kind of play. Do you think that's what's happening as well?
So some of the outflows from balanced advantage, I think, has a relation with that being a category that actually got the most flows in the last 24 months, right? So if somebody's looking to take some money off the table, that's one of the spaces he or she will look at. I think from a fixed income perspective, obviously target majority funds have had very decent flows for a while now. But I think they face severe headwinds from alternates which are fairly direct, which is fixed deposits. I think the story for fixed income that we're able to talk to investors about, that perhaps rates are peaking out, and from a 3 to 5 year perspective, it may not be a bad idea to invest, is getting more and more resonance, right? And I think eventually that will see people cutting checks. I think people today are nodding in appreciation at the logic of the argument, but they're not cutting checks. I would suspect over the next couple of quarters, you'll see some people cutting checks. The other thing I think we should not forget is I think the average Indian investor in funds is getting more mature. I mean, take, for example, the flows into arbitrage funds. After 9 or 10 months of significant outflows, investors see the returns coming back in arbitrage, and that's also seeing significant inflows over the last month or two. So my suspicion is that the divide between, let's say, investment rationale and actual flows with fixed income will happen in the next couple of quarters.
All right, got it. With that, we're going to wind down this conversation. So Anthony, Sunil, thank you very much for joining us and breaking down the mutual fund data for the month of December for us. We're waiting by for the SIP figures. The call is at 12. The AMFI call is at 12. So we will get that figure in a few minutes. But, overall equity inflows looking good. There was some profit taking that we saw last month. That figure once again has picked up. Large caps have seen an outflow, but the outflow is much, much lower than what we saw last month. And the debt fund continues. It's around 22,000 crores in terms of the figure for the debt funds. That's what's going on from the mutual fund space. We're going to get into a short break, but when we come back, we'll put the spotlight on the autos. So stay tuned for that.
Okay, well, since the market is still under quite a bit of pressure and there's no respite in trade, let's talk about individual stocks then. Tata Motors is the one that's bucking the trend this afternoon and seeing big gains at the moment. That's because of a very strong rise that Tata Motors has seen in the Jaguar Land Rover wholesale numbers for this quarter gone by, that's Q3. The Q3 wholesale data is up almost 6% quarter-on-quarter and 15% month-on-month, year-on-year rather, at 79,591 units. Now, this is excluding the Chery Jaguar Land Rover China JV. This is generally, this JV numbers are excluded because Tata Motors, while calculating revenues, looks at these excluded numbers. The numbers at 79,591 units is a growth of 15%, and it's a record order book of over 215,000 units that Tata Motors is seeing. A lot of brokerages are bullish on the stock. CLSA has upgraded it to a buy with a target price of 512. They say that an improvement in volumes and margin profile will aid the free cash generation for the company in this year. And Morgan Stanley says that JLR will generate 400 million pounds of positive free cash flow. I also want to look at that graph that just popped up a while back. It's basically the last 4 quarters of JLR performance. It will give you an indication of how JLR has really done well purely because the supply side issues have, sort of eased a bit, and now production has picked up, especially for the Range Rover as well as the Defender. So these are the reasons why Tata Motors is doing well in trade today.
All right, Sonia, thanks a lot for getting us all of the details on Tata Motors. The other stock on our radar is Sona BLW. The company has acquired 54% stake in Serbian company Novelic. Sonia, take us through the details here.
So, this is a very interesting acquisition that Sona BLW has done. It's they bought 54% stake in Novelic, which is a Serbian company. Now, this company provides sensors and perception solutions and embedded systems to auto OEMs. Now, this is very important in electrification and in autonomous driving, which are the buzzwords in the auto sector now. This acquisition, in fact, marks Sona's entry into the sensor and software segment, and the management expects this segment to potentially touch $100 million of revenues within the next 6 to 7 years. Now, there's, the acquisition will be funded entirely through internal accrual, so they won't be taking on any debt. The transaction will be closed in Q4 of this fiscal, and it will be EPS accretive from the first year itself. Nomura put out a note where they say that the growth opportunity is very high in this sensor space because of the high growth autonomous driving as well as electrification segment. They continue to like the company's strategy of focusing on high technology products, and they have a target price of 609 on the stock. They continue to maintain their buy on that name. So, very good up move coming into Sona BLW. But sticking with the auto space, there's plenty that's happening here. BofA Securities in their recent report remains positive on the sector. They prefer stocks like Tata Motors and TVS. Nimesh is here with the details. Nimesh, over to you.
Hi, Sonia. So today, the standard report was on autos, and BofA Securities has today upgraded the 2 stocks in that pack. So they've upgraded Tata Motors and TVS Motors. For Tata Motors, the new target price is 460 for BofA, and for TVS Motors, they've raised the target price to 1250. On top of that, the preferred bets in the auto pack are Maruti and Ashok Leyland. Now, the key themes and the reasons why they're bullish on autos. One, they believe that the valuations are at near mean or below that, and there is an earnings upgrade as well, which is possible. So that's the big headline on which they're bullish on. in terms of themes, they're playing on three specific themes. One, the first theme is the good model cycle, and in that Maruti fits in. The new SUV launches and regulations will mean that there are further upside to the volume growth for Maruti, and hence they are bullish on Maruti. The second theme is the laggards that are delivering well, and in that theme, Ashok Leyland fits in. So they believe that the CV cycle and the fact that they're gaining market share is surprising positively, and that's why they're bullish on Ashok Leyland as well. And the third theme is credible offers in the EV space, and that's where they've upgraded both Tata Motors and TVS Motors. And remember, both the stocks have corrected off late, so there is a risk reward which is favoring them. As far as Tata Motors is concerned, they believe that at these valuations, the market is not giving just zero valuation to the JLR, and that is bearish, and hence they've upgraded Tata Motors. Within the pack, the only underweight, or maybe they've downgraded Hero MotoCorp to neutral, and the only underweight is Escorts. But today, they've upgraded both TVS Motors and Tata Motors to buy, and they've raised the target price as well there.
Thank you very much, Nimesh, for that. Slip into a break. Up next, we'll discuss market fundamentals. Rajesh Baheti of Cross Seas Capital Services joins in next. A little worse now, so 160 points gone in the Nifty. When we started the show at 11 a.m., the Nifty was down 130 points. So in the last 45 minutes, we've seen incremental selling to the tune of about 30 points on the Nifty, and the Sensex has now slipped close to 560 points. Names like Bharti, Airtel, State Bank of India, L&T, ITC, all of them are now trading at the day's low. One level to track will be the 100-day moving average, 17,906. That's an important level. We're still holding about 35 points above that level. But as you can see from the downward sloping chart since the beginning of trade, there is a lot of pressure that we're currently seeing. Rajesh Baheti is now with us, the Managing Director at Cross Seas Capital Services, on the show now, and Director of ANME. Rajesh, morning, and thanks so much for joining in. Thoughts on the market, the risk reward? Everyone's saying the first half is going to be challenging. If yes, how do you navigate it?
Yeah, so, the consensus around the world is that the American leadership, as far as stock market returns, is probably ending. They had a 15-year run. And the Indian markets tend to kind of follow the American markets in leadership because a lot of our stocks are exposed to the American markets, especially the IT sector. The leadership will pass on to the emerging markets, where the gap between India and the other emerging markets is so huge that I think over the next few months, a little bit of that gap leveling is going to play out. So I foresee that the other emerging markets are going to perform a little bit better than India. India may not go down too much because our domestic audience is still pouring money into equities. We don't have too much options because the LRS route, not everybody has access to. So from that point of view, I think we'll at best stay here or turn a little negative. The other thing that worries me is there's been a lot of loose stock on capital gains tax, and that doesn't help the market sentiment. So close to the budget.
Sure. Rajesh, hi, good morning, and thanks for joining in. Since technology is the flavor of the day post TCS's numbers, wanted your thoughts. Would you stay away or would you buy into the dip?
So the way I've been playing technology, and last time also said, is it's a good time. Bellwether stocks are down 25 to 40% from the highs. It's a good time to play covered call strategies on this. So you buy the stock and sell out the money calls. I don't think this sector is going to race ahead. Having said that, it's debt-free. There's a huge cash flow that these companies continue to churn. So it's always a good bet whenever these stocks are down 25 to 40% from the highs to start nibbling into them and maybe sell out of the money calls, because I don't see the American markets also doing that well, and American companies upping their spend on IT to the extent that this will lead to 40-50% price appreciation in the price of these stocks. So the best case scenario for these stocks is to buy into them and create a yield by selling out the money calls.
All right, that is on IT. Rajesh, good morning. What do you think of the banking space then? I mean, of course, we've seen a big rally specifically in the PSU banks. But do you think if you were to put some fresh money to play, this area still looks attractive and can still churn out some good returns?
So I still maintain it's a medium-term outperformer, but the rally has been so tremendous and so steep. I think it'll need a breather. we're likely to see a breather now. It's happening already. I think the last few sessions, the bank Nifty is clearly under pressure. Every time it goes up, there's a lot of selling. So I'd say, wait for better levels to get in. But over a period of a year to two, I think this will continue to be an outperforming sector.
Which could be the dark horse in the next 6 months? IT, you said, is unlikely to outperform or race away. PSU banks are likely to take a bit of a breather. Which one would you bet on for the next 6 months, which could give you outsized gains?
As I said, I don't even know if anything will give us gains in the next 6 months. I think it's better to wait for the budget. There's been some talk on capital gains. I hope there's not too much tinkering with that. Everything that makes life simpler is welcome, but just raising taxes is not such a good idea, especially because the whole idea behind a concessional capital gains tax was the securities transaction tax, and now we've slowly crept up in terms of taxes on both. And to further raise taxes on capital gains or changing the holding period from, say, 1 to 2 is not going to help the market. So I think if you're really looking for value, it's better to wait it out a bit. I feel you'll get better numbers in terms of entry prices.
Okay, what about autos? Would you buy auto stocks now, especially these global players like Tata Motors, where things are improving in terms of demand, supply side issues are easing as well?
So it's interesting when you say these global plays, because if you see the PE of Volkswagen, it's at 6. So if you're looking for a global play, why would you look at Tata Motors? Having said that, Tata Motors over the last few cycles, you've seen the domestic cycle not doing well when JLR does well, and vice versa. I think at this time, both of them are coming together. Both of them look positive. So from that point of view, I think it's a stock that could outperform in the next 6 months for sure. Because for the first time, I see both the numbers coming together, and the Tata Motors domestic market in terms of its EVs and its new launches, I think have been very well received by the market.
Okay, that is on Tata Motors. Rajesh, we'd love to chat some more, but unfortunately we're out of time. So thank you very much for joining us and taking us through your call on the market and some of these individual pockets as well. With that, it's time for a short break on this show, but there's lots more market action coming up for you in just a bit. Welcome back. So the market continues to be under pressure. It's actually pretty much at the low point of the day right now. 160 points gone on the Nifty. The Nifty Bank has also slipped further. So we're seeing an over 500-point cut on the Nifty Bank index. What is doing well is the auto pack, like we've been telling you, and some of the pharma names. In fact, that index has also moved up in the past few minutes. So the likes of Apollo Hospitals, Divi's, something like a Sun Pharma doing well, and also a few of the PSUs have picked up in the past few minutes. So Power Grid is actually the top gainer after, of course, Tata Motors. Power Grid doing very well. ONGC has also moved up. So these stocks are holding up in an otherwise weak-looking market. In fact, this is the same trend that we've seen play out across Asia as well. So a little bit of slip coming through on all of these markets. But with that, we're going to wind down on this edition of Trading Hour. Thank you guys for tuning in, and halftime report after this short break.